Good morning. It's Friday, the 12th of July, and this is Govindraj Ethiraj broadcasting and streaming from and headquartered in Mumbai. The take as we start off India's meme stock revolution. You may have heard of GameStop, including the film Dumb Money that was made around it. In early 2021, a bunch of day traders led by a homebound dad called Roaring Kitty trounced institutional investors and drove up the stock price of GameStop. The retail investors and day traders believed that GameStop, arguably the largest video game and merchandise retailer in the world with over 4,000 physical stores, but a hybrid brick-and-mortar cum digital company, to put it simply, was undervalued and being shorted by hedge funds who sit on Wall Street because of its declining performance. Now, the details don't matter here, but what does matter is that these investors somehow took it upon themselves, including banding together on Reddit, and sent the stock price up. What accelerated the synchronization of that effort was, of course, social media and the presence of a leader of sorts. Now, this was 2021, also the time most of us, were sitting at home and staring at our computer screens. It's also the time millions of Indians, young Indians particularly, quite likely entered the stock markets here and started and continued to buy derivatives at such massive scales that they made India one of the largest derivatives trading markets in the world. And then, of course, stocks and stock prices moved up on the basis of little information and largely guesswork. Now, India has also seen a deadly mix of slick stockbroking apps, social media-led influencers or finfluencers who thankfully are being now roped in, and of course, the driving desperation to get better returns on savings in a high inflationary environment with wages and incomes growing slower than most people desire. Now, you could say that this is all the classic ingredients of a bull market with some differences, of course, for the fact that this is 2024. Now, equally, you can't blame anyone specifically, except that as regulators or government, you can only ensure that there is integrity in the market with its systems and surveillance measures working fine. But it is clear to me that the meme stock phenomenon, as it was called on Wall Street and is still being called so, is now firmly dictating prices of many stocks in India, and why some care is important. So let me pick up one example, which is the most recent, at least in my mind. The Shipping Corporation of India's stock price rose about 19%, almost 20% to hit an all-time high of 328 rupees on Thursday. Overall, in yesterday's trade, as Business Standard points out, shipping stocks, including Shipping Corporation of India, SR Shipping and Sadhav, were buzzing in trade. This year, shares of Shipping Corporation of India have already doubled in comparison to the BSE Sensex, which has gained about 10%. Meanwhile, the stock price of Sadhav, which is a SME or a small and medium enterprise shipping company, also rose 19% to an intraday high of 262 rupees. SR Shipping was locked in the 10% upper circuit at about 56 rupees. GE Shipping or Great Eastern Shipping Company was up about 13%, another record high. Shreyas Shipping 19%. CMAC 7.4% record high again, and in comparison during the day, as we will come to, the BSE Sensex was down about 300 points at least during the day, and then finally closed a little lower. Now, what is triggering all this? As I can see, mostly speculative news. The first appears to be, in no particular order, news that the government was considering major proposals for the shipping sector in the upcoming Union Budget 2024. The Business Standard, which has compiled most of this, quoted a TV channel report saying the government may propose a maritime development fund in the 2024 budget, which will be read out on the 23rd of this month. Besides, a Harit Nauka scheme could also see the light of day. The Maritime Development Fund may get an allocation of 15 to 20,000 crore rupees, while the Harit Nauka scheme may say incentives for ships which run via hydrogen. Now, ships running on hydrogen is an excellent idea, though it's not clear to me how this appears to be a near-term win, particularly from a stock price point of view. But then, thanks to this, shipbuilding stocks were also ruling higher. Mazagon Dock Shipbuilders was up about 2.5%, Garden Reach Shipbuilders 5%, Cochin Shipyard 4%, and Garware Marine Industries 5% in the upper circuit. Now, a lot of these stocks have not gone into the details because I was picking up all of this only overnight, have not really moved in many, many years, and surely not in the way they're doing so now. And then there was more news earlier that the Shipping Corporation of India and the Indian Oil Corporation would form a joint venture to form a new company to make very large oil tankers. Now, why the Indian Oil Corporation was needed for this specifically is not clear unless it was for the capital, but that's a totally different story. Either way, most of these stocks are riding high on the government's Go Local thrust. Simultaneously, another report, again the Business Standard here, says the Finance Ministry's Department of Investment and Public Asset Management, or DIPAM, is in an advanced stage to push through the strategic sale of the Shipping Corporation of India, which means at the beginning or end of all of this, Shipping Corporation of India would get sold or greater parts of it. So which at this point, by the way, appears extremely remote to me, given the government's proclivity to be in the business of doing business and only extending its tentacles as all evidence suggests. So the Shipping Corporation of India is of course not the only meme stock. There are several, particularly in the public sector space. But do note, all these companies are fundamentally fine. Steady financials, growth prospects, capable managements, and so on. But steady is the word. They're not con jobs for sure, but the valuation of their stocks, well, I'm not the first to bring this up. Several veteran market investors have posed the same question in recent months. But to a bunch of individual traders and charged up investors led by God knows who, the concept of valuation does not clearly matter, particularly if they are operating knowingly or not so knowingly together with some larger objective in mind. And that is why we're in the middle of a meme stock revolution. And now let's look at the top stories and themes for the day. A global stock market rally is still on, powered by Wall Street and Japan. TCS results meet street expectations, but value of new contracts falls almost 19%. How will earnings season play out this quarter, and how have companies fared in the last 3 months? Accenture buys 2 chip design companies with an India footprint in a week. What does this mean for IT services companies and the way forward?
This is a core report with Govindraj Ethiraj.
A global market rally is still on. Well, Indian stock markets are still taking some deep breaths. But before I come to what else has been happening elsewhere and why that's important, let's start at home. On Thursday, the benchmark indices, the Sensex and Nifty 50, stayed weak with a fair bit of selling in the larger cap stocks. The BSE Sensex ended the session 27 points lower at 79,897. The Nifty 50 closed down 8.5 points at 24,316. So all in all, not much of a move. But both indices fell during the day and bounced back, though, as I said, a little lower. As you can see, the Sensex is still below 80,000. It's important to note that while the Indian markets are pausing for direction, global markets are still hitting highs. On Wednesday, the S&P 500 hit a fresh record, breaking above 5,600 for the first time, driven by a sharp rise in, no prizes for guessing, semiconductor stocks. The index closed at 5,634 and was up for the 7th straight day, according to CNBC. The Nasdaq Composite was also up, hitting an all-time high, ending at about 18,647. This was the 37th record close in 2024 for the S&P 500 and the 27th for the Nasdaq, which is weighted by tech stocks, according to CNBC. The Dow Jones, meanwhile, was up about 429 points at 39,721. Chip stocks were amongst the largest winners of that session, including Taiwan Semiconductor, Qualcomm, and Broadcom. And who can forget artificial intelligence darling, to use CNBC's words, NVIDIA. But it was not just Wall Street. Japan's Nikkei 225 crossed the 42,000 mark for the first time amidst a broader rise in Asia-Pacific markets on Thursday, except India, that is, after the big rally on Wall Street that I just referred to. The Nikkei was up about 0.9% to close at 42,224, powered once again by technology stocks. So where all of this leads to India, and will it lead anywhere right now, is a bit of a doubt, as India is taking sharp and deep breaths, as I said. And the big direction-changing event is the budget, which is still about a week and a half away. TCS results are out. Tata Consultancy Services kicked off earnings season for the first quarter of the financial year, reporting a net profit of about 8.7% year-on-year at 12,040 crores. Profits were down 3.1% sequentially. Revenue for the quarter was up 5.4%, that's year-on-year, 62,613 crores and 2.2% sequentially. So at 62,000 crores multiplied by 4, you're still looking at a company that's about 240,000 crores plus in revenue. Now, TCS's quarter one performance exceeded Bloomberg estimates on revenue and net profit, but margins were at about 25%, an expansion of 1.5% year-on-year. The company's order book, however, shrank to about $8.3 billion, roughly 19% lower from the $10.2 billion in the year-ago period, and 37% down from the previous quarter, the company said. Now, of course, deals can move up and down quarter to quarter, so I guess a longer-term trend is what one should look for. In the March quarter, though, of last year, TCS had reported a record high order book of 13.2 billion. So if it was 13.2 billion, it's now 8.3 billion. Interestingly, as per reports in Money Control and Business Standard, the growth driver for the first quarter of TCS was emerging markets led by India, which grew at about 62% year on year, thanks largely to a deal with state-owned telecom major BSNL, followed by the UK at 6%, and notably the United States continued to be subdued and down. The good news, if you were to call it that, TCS added about 5,500 people to its headcount, and that number is important because the company, like all others in the IT services space, has been shedding people in the last few quarters. Attrition levels were at 12%, and the total workforce stood at about 606,000 as of June 30th. TCS is, of course, the first off, and the results seem in line with projections and estimates, as we've been saying. It will, of course, be interesting to see how the other majors like Infosys, Wipro, and HCL Tech report their numbers and what insights we could take away. All of this will reflect a few important things. First, the state of the North American, European economies and the companies within them and how they're investing in technology, the march of artificial intelligence itself, and the ability of Indian companies to cope with these rapid changes and to improve their offerings, so to speak. And we'll come to more of that in a moment. How's earnings season shaping up? Earnings season is kicking off, but there are many more companies whose results will reflect the fundamental trends in the economy in terms of demand, supply, and price trends. What do we know of how companies have done in the last quarter that reflects both their performance as well as, to keep coming back to it, the underlying economy? So we've seen some price shifts and demand moves. What is the impact of this, including in traditional industry? I spoke with Sanjeev Hota, Vice President and Head of Research at stockbroker Sharekhan by BNP Paribas. And I began by asking him the larger trends he had seen in the last quarter, industries that stood out and why, and then specific sectors he was tracking more closely.
So for Q1, narrative has not changed. It's similar to what we have seen in the recent quarter. Domestic cyclical continue to drive the momentum and they are expected to deliver healthy numbers in Q1 as well. But if you take Nifty 50 numbers, Q1 numbers on an overall basis expected to be a modest kind of growth of 3%. But that is largely driven by drag coming from the energy space. So if you exclude the BPCL and ONGC from the Nifty 50, the numbers on the PET side still looks decent, or now 8% Y-on-Y growth. So as I said, the domestic cyclical like bank, autos, infra, capital goods are continue to drive the momentum. And that has been the narrative that we have seen in the recent quarter. And that is what we are expecting this quarter as well. So one broader trend, what I'm seeing from the Q1 numbers, that the margin benefit may not be there as we have seen last year. And also the base effect is coming into play in certain pocket. And that is the reason why we might see some kind of moderation in the earning growth if you see on a Y-on-Y basis.
So, and you're saying margins may be under pressure, and is that more in some sectors or is it across the board?
So last year was total benefit of the commodity that was there coupled with the price hike most of the companies has taken. So that came into play last FY24 overall, if you see. But this year, I don't really see that is going to be a play for the overall FY25. The margin benefit may not be a big kind of trigger that could play out for the entire FY25. And for this quarter also, this is a seasonally weak quarter for some pockets. So that is the reason why I'm saying that there could be a possibility of the margin moderation seen in this quarter.
Right. And, we've had a lot of inflationary pressures. For example, we've seen heat waves, extreme weather conditions, which has affected food prices, vegetable prices, and so on. And also sales of some products. For example, the auto industry has said that sales were down because store walk-ins were down. And I'm sure many other industries. So is that at all impacting how Q1 is looking or results are looking?
So for Q1, if you see the major impact of the monsoon or food prices or this summer which has been extended, it is going to impact some sector. Like if you see the extended summer could benefit the sectors such as AC and stabilizer and some of the other product companies. But for the monsoon, the actual benefit for the rural sector will visible in the Q2 FY25. And we have seen that although the monsoon had delayed start, but recently data suggests that it is recovered quite well. So if it's continue to do so, I think the major reflection will come in the Q2 FY25, and the Kharif number is already showing a decent kind of growth, almost 14%. And there might be some possibility of rural growth announcement coming from government. And the government is already taking measure to banning some of the key commodities like rice and sugar to curb inflation. So I believe that rural companies like FMCG, the major one, the commentary is going to be good for the coming quarters, and the headwinds what they have seen in the last 1.5 year, it's already out of window. So directionally, I believe they are going to post good numbers.
Right. So you're saying even if there was pressure in Q1, it would be made up in Q2, if I got that right.
No, I'm talking about monsoon. The key thing that
So
I
the
think
monsoon is the positive news. My question is more on, let's say, what happened in the months of May and June across India, which seems to have affected, for example, let's say auto sales or prices of fruits and vegetables, food overall. So you're saying that has not really had an impact on at least the company universe that we are looking at.
coupled with the last quarter, this heat wave and all, that was the election season was also there. So definitely some company, some pocket is going to get impacted. But when we see a inflationary kind of numbers, I think it is trending down. So I don't really see a major significant impact on any of the other companies. What I'm worrying about is the global commodity prices. So that is on a higher trajectory, and that could impact some pocket. But if you ask me about the domestic food prices and all, I don't really see it's going to have a major impact on any of the pocket I'm talking about.
Right. And which commodities are you particularly concerned about when you say global commodity prices?
So if you see across metals that has went up steeply in the recent time, and coupled with we have seen that there's a supply chain side issue emerging from the Red Sea crisis. So that is going to impact some of the companies, if not everyone. So some of the export-driven company like auto ancillaries, also some of the textile companies or the major exporters that might see some kind of impact in this quarter, not materially, but definitely some kind of impact.
Sure. And last question, Sanjeev. So, we saw some price movements. For example, we saw some auto companies like Mahindras and Tatas reducing prices on their SUVs by almost 10%. And elsewhere, we've seen paint companies like Asian Paints and Berger Paints increasing prices. So, what's the broad sense you're getting with all of this? I mean, is lower prices, more demand, higher prices, lower demand? How is it likely to play out for some of these sectors?
Okay, so if you see the sector-specific price action always into the play, it is not like it's happening for the first time or the last time. It's always into the play to sometimes it's to drive the volumes, to drive the festive demand. Sometimes it's to negate the commodity inflation. So every time there is some other cause that drive the price action. So recently for the paint companies, if you see it, the price increase is coming after a gap of almost 15 to 18 months. So everyone in the state is waiting for the Birla Group Opus paint to be launched. And the recent price hike, if you see, is only 0.7 to 1%, less than 1%. So that is not going to have a material impact on the volume. And anyway, Asian Paint, if you see, they're still maintaining the dominance position in the paint industry. So I don't really see it the major price event that is playing out for Asian Paint, but it's driving the confidence for the street that after the Opus launch also, and they are discount to the Asian Paint prices, and still they are taking price hike. So that is driving the sentiment positive for the paint sector. And if you see the auto sector also, it's a different kind of phenomenon. Recently, if you see the TML, CB, Tata Motors and Hero Moto has announced the price hike for the July. And the Mahindra and Mahindra, if you see, they cut the prices along with the TML for the PV. So it's a different kind of action, and that is only to drive some kind of festive demand and also the kind of inventory that is already building in the system. To clear out the inventory, they are taking such action. And also to add to this, if you see the cement sector where the pricing play an important role, at the last quarter, because of the election issues and all, the prices has been muted. But going forward, I definitely see some kind of price hike also coming in. So it's always a different case put together in a different time.
Right, Sanjeev. Thank you so much for joining me.
Thank you.
Thank you for listening and your support for the Core Report. We've been streaming for a year, and we think this is a good time and ripe for a quick feedback from you on what we can do new and better on this podcast. And thank you, as always, for some good critical feedback. The link to a short survey is in the show notes. Accenture buys 2 chip design companies in a week. What does that portend? So earlier this year, Infosys announced the acquisition of InSemi, a semiconductor design and embedded services provider. The size of the acquisition was reported at 280 crore rupees. Now, in the last week, Accenture, an IT services company, or broadly consulting and IT services company, which is global but with a strong India footprint, has been on an overdrive. A few days ago, it said it acquired XLMax Technologies, a Bangalore-based semiconductor design services provider. The objective of this acquisition, terms of which were not disclosed, further enhanced Accenture's growing silicon design and engineering capabilities, the company said. Now, that was last week. Just yesterday, Accenture said it acquired Cientra, a silicon design and engineering services company, once again offering custom silicon solutions for global clients. Cientra was founded about 9 years ago and is headquartered in New Jersey and has offices in Germany, Bangalore, Hyderabad, and Delhi. An Accenture release said Cientra brings consulting expertise in embedded IoT, that's Internet of Things, and application-specific integrated circuit design and verification capabilities, which in turn augments Accenture's silicon design experience and further enhances its ability to help clients accelerate semiconductor innovation required to support growing data computing needs. So I'm narrating all of this because it gives you a background or perspective on what Accenture or Infosys are looking for, and we will come to more of that. In most of these cases, the acquisitions bring several hundred engineers into Accenture's fold, and I'm sure that's the case or was the case with Infosys as well. Earlier, Accenture acquired Extreme EDA, an Ottawa, Canada-based silicon design services company, but that was 2 years ago in 2022. So the larger question, of course, with these acquisitions is, are Indian IT services, in this context, Infosys, able to find new ways of growing the otherwise slowing IT services market, as is quite evident from the many results that we've already started talking about? More importantly, where does this place them technologically? I reached out to Siddharth Pai, technology columnist, strategist, and founder and managing partner at Siana Capital, based out of Bangalore. And I began by asking him how he was seeing this trend and whether a deeper dive into chip design would help Indian IT services companies shore up their offerings.
For us to understand what's going on in the IT services world with Accenture's move and the Infosys' move, we actually need to step back a little bit and understand what's happening in the chip world. As you know, there's been a move to AI-based applications in the last few years, which has been accelerated tremendously in the last couple of years with Gen AI coming on the horizon. And essentially, the only chips that are available for the kind of processing that AI requires are NVIDIA's chips. And NVIDIA was originally just a GPU maker or a graphical processing unit maker within, computers, so laptops and things like that, games, things like that. The primary difference in the design between the older chips and NVIDIA's chips is that NVIDIA chips are able to hold and manipulate 3-dimensional data versus 2-dimensional data. Okay. So typically you have data in rows and columns, and therefore those are only 2 dimensions. And when you put a third vector or a third dimension in, you have not just the X and Y of the row and column, you also have a depth perception that's required. So you can have a third dimension to how you actually manipulate and use data. So rather than just having chart, which is a square or a rectangle, you actually have a cube or a cuboid as a result, which is manipulating data. With AI applications, a lot of the newer ones require it's not just 2 variables at the same time, it's 3 or more variables at the same time. And therefore, you need a chip that's capable of managing across 3 dimensions at least, which is where the GPU chips used to excel. And as a result, their move into AI is the reason why NVIDIA has been doing so well. NVIDIA is the only one that had large enough design capabilities, fabrication units, things like that they had tie-ups with in order for them to be able to design and manufacture chips at scale for the AI revolution. And that's why their stock has gone through the roof. And of course, Dr. Hong is now considered a great visionary. I wish I'd bought more NVIDIA stock, but nonetheless, they have seen some ups and downs though. Today, I'm told that it takes sometimes get in line and you have to wait in queue for up to 24 months in order to be able to get NVIDIA-enabled machines. So obviously, he's dealing with demand that he can't really supply to, which creates a vacuum in the market. Now, the way around it isn't necessarily by building fabrication labs and so on, fabrication units and so forth, because places in Taiwan and other places, China and other places have already spent the billions required in order to make that happen. Where the real money is in the design of such chips, right? Which is where NVIDIA for today has the lead. Now, there are 2 or 3 different types of chips that can take this place. I won't go into a long discussion. Something called tensor chips, which people have been experimenting with, and of course other 3-dimensional chips, akin to but still different from in the way that they handle data, akin to NVIDIA's units. So there's room for a lot of competition simply because the demand is as large as it is. And for now, to make the segue to IT services companies, to get ahead of the curve, because they're behind the 8 ball. Certainly, Indian providers are behind the 8 ball when it comes to AI, Gen AI, and what's going on. And as a matter of fact, for them, it's a huge cannibalization of potential existing revenue, because a lot of the work that they do isn't necessarily differentiated. It's differentiated on cost, but not on the type of work that's being done. And that'll be one of the first casualties of the Gen AI type of revolution that we're seeing right now. So therefore, it makes sense for them to get ahead of the curve, because insofar as you're doing AI chip design, it also makes you a thought leader in that space. It's a large market, so therefore, as a result, large potential market. So therefore, as a result, if you can take chip design and convert that into revenue from computer makers, so that's another play. And third, of course, is the ability to pivot your company away.
Right. Okay. So, what are the kind of companies that would buy these services then? I mean, if you said NVIDIA is absolutely at the top of the pile, and of course, there are so many other chip makers, but would these companies contribute to an Accenture, to a large chip making company? When I say these companies, I mean Infosys plus Insemi or Accenture plus SL Max and so on.
Very much so. I mean, it's the fabrication and so forth of the chip is, though it takes capital and money, is less of an issue than the actual design. So if you're looking at large firms that have fabrication units in place already, either in Taiwan or in Korea and on places like that, they're all large buyers of chip design for them to be able to compete with NVIDIA. You have Intel, which by the way seems to have lost its way. These are all established players in the market who've been there for a long time. And there's no reason why they can't compete with NVIDIA. And if there's worthwhile designs that can be sold off to them or co-developed for them, then that's a long revenue stream that can be expected for a fairly significant period of time coming from chip design manufacturers. The second thing that comes from that also is an insight into how data is actually manipulated in the AI world. So therefore, you would create the chip design guys are actually creating sufficient exhaust behind themselves for data scientists and others to enter into the equation to provide further services to customers outside of just the chip manufacturing and chip fabrication space. So I think it's a brilliant move on part of both companies. With Infosys, I think they're probably trying to get ahead of the curve this time. Accenture has proven time and again that they're up to the task. They moved from being a management consulting company to being an outsourcing company. When outsourcing moved offshore, they, in a matter of no time, went up from 200 employees in India in, say, 2002, 2003 to tens of thousands, to the point where I believe more than half of their employees were here, something like 150,000 or 160,000 or 300,000 sitting in India out of 300,000 worldwide. They were also smart enough to really move up in the Philippines, where they had 40, 50,000 people, because they understood that low-cost provisioning was important. And then they've made the shift now into digital marketing in a big way by stringing together 44 acquisitions. Accenture has for many years now been the largest digital marketing agency in the world, which is something very few people realize. You don't think about that for a typical IT services company, but think about it. If their revenue from that unit alone is larger than all of Infosys' revenue. So as a digital market, just from digital marketing, they call it the Song business unit, SONG. Just the Song business unit has revenues that are greater than Infosys. So you can imagine the alacrity and speed with which Accenture has moved in the past. And I have nothing but admiration for the speed at which a company that size can move as quickly as it does. And so, and seeing that they're getting into the space actually means that I would expect them to really accelerate. I hope this is Infosys waking up and realizing that they need to take something out of the Accenture playbook and reinvent themselves as they go forward. If they've actually figured that out, then, hats off to them. Otherwise, this string of acquisitions, we'll see where we go, take it easy. We don't want to, disturb the current apple cart. That sort of conservative view, where they're sitting on a lot of cash, has been typically what Indian services providers, including Infosys, have done. But now, maybe Infosys is trying to break away from the rest. Let's see, But if you're going to take a page out of Accenture's book, I think it's actually a good thing for the industry in India.
Right, Sid. Thank you so much for joining me today.
All right. Thank you, Govind, for having me. Take care.
Before we go, here's some feedback that you've sent, all of which is very useful and is effectively action points for us here at the Core Report. Mihir Thakkar says, request you to feature a section on cybersecurity concerns faced by individuals, body corporates, and government departments. Cybersecurity skill gap is a big issue and needs a holistic approach by academia and industry for resolution, and also could address unemployment in some way. He's also attached a report of the Information Systems Audit Control Association, which I will look at and use. Tara Abasti, a third-year undergraduate majoring in economics with a minor in literary and culture studies, says she's a reader of The Core, that's our website, and she also listens to The Core Report every evening on her way back home. She thanks us for pursuing what she says is such a high quality of journalism, which is especially impactful on young students like her, and she feels hope for independent journalism in media in India because of publications like The Core. Tara, thank you very much. This is most encouraging, particularly coming from someone young as you. And we do hope to find subjects that are important and useful to you. Thank you for tuning in, and do keep sending us your feedback. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at The Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.